That is business financing, or what we call sources of finance, finance success. We started this class last week. We are looking at the various methods of financing business activities. A quick recap of our discussion. We try to emphasize that method of financing companies' assets is a major aspect of financial management. How you choose to finance your business how the company chooses to finance its business activities will have impacts on the company's cost of capital, your cost of financing. Your cost of financing will have impacts on the value of the company. Hence, companies should choose wisely. Companies should use finance success that minimizes your overall cost of finance. We discussed this. We discussed short-term finance success. We discussed bank overdraft, short-term bank loan. We discussed trade credit. We discussed debt factoring and operating lease. These are classified as short-term finance success. We also discussed long-term fund. Long-term funds are required for long-term projects to finance long-term investments or capital assets. Under the long-term fund, we discuss equity financing. So I'm trying to do a recap. We discuss equity financing. Finance contributed to the business by the owners of the business. Who are the owners of the business? The shareholders. So equity finance, money contributed to the business by the shareholders. We equally discuss equity finance success, which include retained earnings. You can finance your business with your retained profit. Profit that is not distributed to shareholders as dividends. Company can use this as a source of financing. We only discuss issuing new shares. Company can issue new shares for the purpose of raising additional finance. There are different ways or there are different methods by which company can issue new shares. So as to raise additional cash. And we say there are three ways company can do this. We have public offer. Company can do public offer. Issuing new shares for purchase by the general investing public. That is public offer. Also called offer for public subscription. We discussed this last week. We also discussed placing, a situation where company issue new shares to a relatively small number of selected investors. The shares are not announced public. The new shares are not announced to the public. It is issued to a selected number of investors. We discussed this in our class last week. We also discussed rights issue. There are three ways company can issue new shares to generate cash. 1, public offer. 2, private placing. 3, rights issue. Rights issue, issuing new shares to existing shareholders at a subsidized price, at a reduced price, so as to generate additional funds from the existing owners, so that we can generate additional funds from the existing owners. We discussed this last week. We call it issue price. The discounted price at which new shares to shareholders. Also explain right price as well as theoretical X-right price. We said when a company announces a right issue, the market price of the existing shares just before the new shares take place is called right price. Please don't forget, for a company to do right issue, that company must have shares in existence. The existing shares must have a price at the stock market. The price of the existing shares before the right issue is what we call right. Now explain theoretical right price. we said theoretical strike price is the expected share price or the estimated share price after the completion of the right issue. After the company has completed the right issue, your theoretical strike price is what the share price ought to be. We explain this also. We equally explain yield adjusted theoretical strike price. Abdul, please can you mute? Moridia. Thank you. We said yield adjusted theoretical strike price. This is calculated where returns generated on your new fund is different from return generated on the existing fund. Yield adjusted theoretical strike price will be calculated in a situation where the return generated on your new fund is different from the return generated on your existing fund. Please don't forget, if you are doing right issue, that means you are trying to raise a new fund. You are trying to raise additional fund, a new finance. The new finance will be invested to generate returns. The existing finance, your existing fund, is also invested to generate returns, where your return on existing fund is not the same with return on your new fund. In that case, you are going to calculate yield adjusted theoretical right price. We also discussed choices available to shareholders in a right issue. When company embark on right issue, you are issuing new shares to existing shareholders as rights to buy, not an obligation to buy. The existing shareholders can decide whether to buy or not to buy. You can decide to buy. You can decide to sell to another person. You can decide to buy some and sell some. Or you can decide to ignore the rights. We explained this at our class last week. We now look at long-term debt finance success. How can companies source money using borrowing on long term? We discussed this, that company can issue bond, a debt instrument that company uses to borrow money for a long term. This bond might be called debentures or loan stock. We discussed this. And we discussed that this debt, they are marketable debt security, a bond, a debt instrument that is tradable, that is marketable. Investor can buy, investor can sell. We also discuss bank loan, long-term bank loan. Company can obtain borrowing from and we said bank loan is not tradable. Bank loan is not marketable. All right. We discussed that when we come to debt financing, the debt may be redeemable or irredeemable or convertible. Your debt finance can be redeemable debt, a debt with a specific repayment period. That instrument is redeemable. You also have irredeemable debt. A debt without a specific repayment period. The principal amount will not be repaid. Only the interest will be repaid annually. We discussed this. And we discussed convertible debt. Debt instruments that can be converted into equity shares. We explained that debt finance might be secured against assets of the borrower, or you can have unsecured debt. The debt finance might be secured. So if you are trying to borrow money, if you are trying to use debt finance, you must consider availability of assets that you can use as collateral for the loan. And we also stress the fact that when it comes to borrowing, if a company utilizes debt finance comes with conditions, covenants that is attached to the borrowing. If you are trying to borrow money, the lenders will give you some conditions. These conditions are called loan or debt covenants. Once you borrow the money, you must comply or you must abide by the condition. We discussed this. Of course, we didn't discuss Islamic finance. That will be later. But that was where we stopped last week. I think that was where we stopped last week. All right, tonight, let us put questions to some of the things we question. Although the question was also ICANN texted. Let's start with check your study pack. Question. I should have a lot of students in this class. Let me confirm the page again. Why not question 7? Page 130. I'm trying to reconfirm the page. I'm trying to reconfirm the page. That page has changed. Yeah, check page 52.
Page 152 in study pack.
Yeah, your study kits. Page 152, question 7. Let us start with this question. Are we good to go, please? Are we good to go?
Yes.
Yes. Balama PSC. In bracket Balama is a listed manufacturer of dairy products. The company has experienced only a modest level of growth. But following the recent retirements of the chief executive, his replacement is keen to expand Balama's operations. The board of directors has to support the proposal by the new chief executive that the company purchase a new manufacturing equipment to enable it to expand its range of dairy products. Will cost 50 million naira. And the company is seeking to raise a new finance to fund the expenditure in full. We need to raise new finance. However, the board of directors is undecided as to how the new finance will be raised. The board is considering either a 1 for 5 rights issue, or at a price of $2.50 per share, or convertible loan of 50 million. Now look at that. This company needs to generate 50 million naira finance. Considering either a 1 for 5 rights issue, issuing new shares to existing shareholders at a subsidized price so as to generate 50 million naira, or convertible loan of 50 million. The loan will be secured against the company's freehold land and building. Look at it. Secured debt. The debt will be secured on the company's assets. What that means is that in case this company cannot pay back, the lender will go to that asset. All right. The company's share price is currently quoted, the company's share is currently quoted at a price of 3 naira per share. Requirement for 3 marks. Explain the terms, rights issue, and convertible loan. This question was texted at the professional level. So, who is going to keep the ball rolling? Who is going to explain rights issue and convertible loan? 3 marks. The class has started. Where's evening? Yes. Yes. Okay, we have a Zag. Am I correct?
Yes, sir.
Yeah.
So, rights issue is like a privilege given to existing shareholders to buy new shares at a lower price, which is below the market price.
Okay. Privilege given to existing shareholders.
Yes.
Yes.
To buy new shares at a lower price below the market price.
All right. Now, convertible loan.
Convertible loans are debt instruments that provide options given to the debt holders to convert the debt to equity.
All right. Convertible loan. A debt instrument that provides conversion option to the debt holders. A convertible loan. These are debt instruments that gives the debt holder the option or the rights, but not the obligation, to convert the debt to a number of equity shares within a specified future period. So please, in your exam, you must choose your words wisely. For rights issue, Right issue is issuing new shares to existing shareholders, usually at a reduced price, so as to generate additional funds from the existing owners. It's an equity source of financing. Right issue is an equity source of financing. It is used to finance long-term assets. Convertible loan also. A convertible loan is also a long-term fund, but convertible loan is a debt instrument that provides options to the debt holder to convert the debt to equity. To convert the debt to equity. The debt will be converted to a specified number within a specified future period. Both methods are used to raise funds, long-term funds. All right, Chioma, you say I should come again. From which area now?
I think from the convertible debt, you can start from that place.
That's your own question, oh, not Chioma.
That's true, sir.
All right, what I said is this. Of course, that's correct. Just I'm trying to say that, yes, it's just make a lot of meaning. Your issue is issuing new shares to existing. Take that again. Right issue. Issuing new shares to existing shareholders, usually at a reduced price, so as to generate additional funds from. And I said, right issue is an equity source of finance. We now move to convertible loan. The convertible loan, these are debt instruments that provide options to the debt holder. The debt to equity shares within a future period. All right. We move to a B part of the question. Examiner says, explain how the theoretical strike price £2.92 is calculated, and why the actual price might be different. All right. Examiner has calculated theoretical strike price. He now wants us to explain how this is calculated. Now remember, we said theoretical strike price is the expected share price after we have completed the right issue. What the share price ought to be after the right issue is completed. If you are to calculate this now, I'll pick my pen. Look at the calculation. You open a table, item, quantity, price, and value. Now go to the right issue. Examiner says 1 for 5 right issue. 1 for 5 right issue. If you are to interpret this to yourself correctly, 1 for 5, it means for every 5 existing shares, issue 1 additional new shares or issue 1 new share. For every 5 existing shares, issue 1 new share as rights. You now come here. Our existing shares. 5. Our new share. 1. Go to the question. What is the market price of the existing shares? Look at it here.
3 naira.
3 naira. What is the price of the new share on the right?
2 naira 50 kobo.
You return here now. For existing share, 3 naira. New share, you can see now, the new shares are issued at a price below the market price. Now multiply. 5 multiplied by 3, value 15. 1 multiplied by 2.5, value 2.5. Sum your quantity, 6. Sum your value, 17.5. Please don't sum price. Your theoretical, please. Your theoretical X right price is equal to, let me write it in full. Some might say, what is this again? Theoretical X right price is equal to total value divided by total quantity. That is 17.5 divided by 6. Please work this out. What do you have?
2 naira 92 kobo.
2.92.
Yeah, thank you.
2.92.
Yeah, thanks. You have gotten just 1 minute. So we have explained how the examiner got the theoretical strike price 2.92. Still on requirement B. Examiner says, which we explain also. And we should explain why the actual price might be different. If you look at that definition, we said theoretical strike price, the expected share price after the completion of the right issue. What we expect the share price to be at the stock market after we have completed the right issue. Now the question is, why would the actual price be different from the calculated theoretical strike price? Why? There are three reasons. Let's go to it. Yeah, it's here also. The actual price, the actual market price of the shares might be different from the theoretical price for the following reasons. One, the existence of specific information, positive or negative, regarding the company or its market sector at the time of the issue. Look at that point. Existence of specific information about the company itself at the time of the right issue. Let me explain that. Mr. Moses, please, can you mute? Let me explain that. Assuming this company now, assuming this company is Zenith Bank. Assuming Balama PS is Zenith Bank. So Zenith Bank is doing right issue. Zenith Bank is issuing new shares to its existing shareholders. We now got information that the new chairman of Zenith Bank is now, just for class purposes, that the new chairman of Zenith Bank, which name will I now use, happens to be, what these guys now, I'm looking for a good name that will send the message to you guys. Okay, the new chairman of Zenith Bank happens to be the notorious, what this guy's name? Abdullah Shakaro, those Boko Haram people. You got the information that the new chairman of Zenith Bank now will now be bandits. What will come to your mind? I'm asking the class that the new chairman of Zenith Bank is now an ex-bandit. What comes to your mind?
Well, the company will go down very soon. because
Immediately,
People will start withdrawing their money.
the share price will crash in the stock market. That singular information that we are now saying that somebody who is an ex-militant, has acquired over 50% of the Zenith Bank shares. He's now becoming the chairman of Zenith Bank. That singular information will destroy the share price. What we are trying to say is information specific about a company. We have impacts, can have negative impacts or positive impacts on the company share price, no matter how rich an ex-bandit is. For the fact that he has been engaged in kidnapping and killing, nobody wants to associate with a company run by that person. That will affect the company share price. I will have used different names. No, there are some names too. Okay, let's look at it. For class purposes, imagine we got the information that the new chairman of Dangote Group is now Asari Tokunbo. What will happen to your mind? Yes, Irabo.
Because you assume every money that is coming will be used for his this thing. So definitely I'll have to pull out. I have to pull out my funds if I have any fund there.
Very correct. The thing is, Asari Tokunbo is not known in the business world.
Exactly.
He has his own path in life. Bringing such personality to be chairman of a company, particularly a reputed company, that company share price at the stock market will crash. Investors will be skeptical to deal with that company. That is number one reason. Number two reason, information regarding the use to which the proceeds will be put. Information regarding the use to which the proceeds will be put, and the market reaction to that information. Let me explain that also. A company is doing right issue to raise additional fund. Investor will ask, what do you want to use the money for? Like this question. The money is to buy new equipment so as to expand the company's product range. Then how will market react to that information? That this company is trying to do right issue to raise 50 million so as to expand its product range. If market react positively to that information, actual share price will rise above theoretical exit price. Number 3, expectations of the investors and the stock market regarding the company's future. Please don't forget, investment is about what will happen in the future. If you are trying to invest your money in a company, you are interested in that company's future. If that company's future is very bright, if the expectations about the company's future is very bright, investor will be willing to buy the company shares. And that will lead to increase in actual share price. But if the company's future is not bright, nobody will patronize the shares. Actual share price will fall. All right? These are the 3 reasons. And please, try to memorize this. Examiner has a way of asking this question. Madam Judith, please, can you mute? Thank you, ma. All right, we move to requirement B, requirement C. Requirement A is for 3 marks. Requirement B is for 4 marks. Now requirement C for 13 marks. Prepare a report for the board members that fully evaluates the 2 potential methods of financing the company's expansion plan. What are these 2 methods? Rights issue and convertible loan. Examiner wants you to do a report now. You are going to do a report for the board members, evaluating what is right issue, what is convertible loan. Your evaluation, you are going to assume that the board members are non-accountants. You are going to bear in mind, some of the board members are not accountants. So you need to explain to them what is right issue. What are the benefits of financing a business with right issue? What are the risks of financing a business with right issue? When you are done, you now go to convertible loan. What is convertible loan? What are the benefits of financing my business with convertible loan? What are the risks involved if I finance my business with convertible loan? When writing this report, pour out all you know. These 13 marks, whatever you know, in as much as you have time, pour it out. Let's look at the reports. Look at the reports. To the board of Balama from financial consultants, the date, Your subject, financing expansion plans. Rights issue. Remember, Balama is a public company. That means say Balama PSC. For an established listed company like Balama PSC, for an established listed company like Balama, rights issue are much more popular for the following reasons. These are the benefits of rights issue. Rights issue are relatively cheap to make. Perhaps less expensive than public offer. The issue price is relatively unimportant since all the existing shareholders benefit from the cheap price in proportion to their shareholding. There is no disproportionate gain. The company needs to make the right issue price significantly cheaper than the market price. This puts pressure on the shareholders to take up the new shares or to sell to another investor. If you have a choice, you can buy the new shares at a reduced price, or you can even sell it and make profits. Thus, right issue tends not to fail. The shares tend to be issued and the money is generated. With right issue, control and ownership is preserved. Control tends to stay with the existing shareholders. With right issue, control tends to stay with the existing shareholders. So there is no dilution in ownership and control. The need to discount the offer price is to ensure that the issue is fully subscribed and to cover the possibility that the share price, that the market price of shares might fall. Between the announcement of the right issue and its conclusion, the use of right issue leaves the credit line free to finance further expansion. By using right issue, your credit line is available for further financing. And enable the non-current assets to be used to secure other line of finance. If required, it seems as if right issue will provide a cheaper. You are telling directors now, it seems as if right issue will provide a cheaper and a more practical way for the company to raise the fund for the expansion. Convertible loan. Convertible loan or convertibles are a mixture of loan and equity financing. What do you want? Are you copying it?
No, I just want to screenshot so I can write it later.
Okay. But you know you have it already.
Thank you, sir.
It's okay you are copying, but do you know that this material is with you already? I shared it last week.
Okay, I'll check some.
So what I expect is, if a material is shared after the class, download and save on your laptop. For online class, I think you have to work with a laptop. I'm not sure your phone might be sufficient. All right, convertibles are a mixture of loan and equity finance. They are issued as loan stock with the right to convert them into equity or into equity shares of the same company at some predetermined rates and dates. From the investor's point of view, convertible loans are relatively safe in that there's a clause to guarantee interest payments periodically and a right to convert to equity as an investor. Convertible loan is very safe for me. I'm going to get interest on the convertible loan annually or periodically, and I can decide to convert to equity if it is beneficial to do so. From the company's viewpoint, convertible loans are attractive finance because it is cheap to issue. Loan stock is generally cheap to issue. It is cheaper to issue than issuing equity. Loan finance is relatively cheap to service. Servicing the loan stock is even cheaper because if you pay interest on it, that is servicing. If you pay interest on your loan stock, you are going to claim tax relief. Loan finance is relatively cheap to service because of the tax deductibility of interest charges. The interest charge is tax allowable. The loan stock are self-liquidating. loan stock are self-liquidating, provided the holder convert the loan. Once the holder exercise right of conversion, the loan liquidates itself through equity issues. In that case, the company does not need to worry about repayment. It saves the company the problem of raising cash to repay the loan. Financing your business with loan stock comes with some disadvantages. The likely need to provide security for the loan. This loan will be secured on the company's freehold land and building. That asset will be encumbered. Once you take the loan, that asset becomes encumbered. The possibility that lenders will impose conditions, covenants. If you finance your business with loan stock, the lenders may give you conditions. These conditions may not be favorable. For example, restricting the level of dividends. The lenders may limit the amount you pay as dividends. Or the lenders can insist on minimum liquidity ratio. Financing your business with loan stock will increase level of gearing. That is, the financial risk will increase. But you have submitted to the board. Let the board decide which option they want to use. You have submitted to the board. Now let the board of directors, let the board member decide whether they want to finance the expansion with loan stock or they want to do rights issue. Any question, please?
Good evening, sir.
Yeah, good evening, ma.
Good evening, sir. Yes, in addition to the conversion of the option for debt, so I want to add, can we add this, that the price of the conversion should be higher than the redemption value to boost mark, sir? I mean by the commercial price of the commercial price to equity be always higher than the redemption value.
of course, what we are saying is for them to exercise their rights, for the debt holders to convert the debt to equity, the share price should be higher than debt. Is that what you are trying to say?
The conversion value, the value they get in total, will be higher than the redemption value before they can accept the conversion, sir.
Of course, we said it there now. You didn't notice it. I'm coming. I'm coming. Irabo, yes, you can speak. I will show you now what.
Okay, sir.
Yes.
Good evening, sir.
Yes, I agree, sir.
Oh, okay. So, for the disadvantage of this for the loan, the disadvantage we picked, this second this thing that is towards the end, or insisting on a minimum liquidity ratio. That is the lenders insisting on a minimum liquidity ratio. The screen is up. Okay, so my question now is, okay, so what I understand by liquidity ratio is a company being able to at least pay its short-term debts, that's the current liabilities and the rest. So will it not be to the detriment of the lenders if the company can't, if they are insisting on a minimum liquidity ratio? They are simply telling them, the company, to go down, because the company will go under. If the company go under, how do you then, as a lender, recoup whatever it is, the loan you give out to the company?
All right. I will attend to the two questions. The one from Biola first, and your observation second. So that we can have a clear understanding. I'm trying to do something quick.
The network is bad. It's breaking.
To assist the class also. Please just give me like, okay, I think this is it. Just 1 minute. I hope you can hear me now.
Better.
Hello.
Yes, we can hear you, sir. We can hear you.
I can also hear Irabo clearly. So when you say the network is bad, I was a bit worried. So if others can hear me, then possibly, like I usually say, network is for everybody. The only difference is that because the lecturers speak in laws, so the network is, it could be anybody. So if others can hear me, then it becomes your particular network. But if all the students cannot hear me, let me take it from Viola's comments. Now look at this. We said, yeah, look at this, please. They are self-liquidating, provided the holder converts. The loan liquidates itself through equity issue, which saves the company the problem of raising cash to replace it. There's something I saw somewhere. Okay, look at it here. Hey, look at this. Hey, look at this, please. We said convertibles are a mixture of loan and equity financing. They are issued as loan stock with the right to convert them to equity. Now look at this from here. From the investor's viewpoint, they are relatively safe in that there's close to guarantee interest payment periodically and a right to convert to equity if it is beneficial to do so. You are only going to convert to equity if your conversion value is higher than your redemption as a debt. Is that better, Biola?
Yes, sir. That's good, sir. That's good, sir. I can see.
So now we put a clause. If it is beneficial to do so, meaning that for me to convert my debt to equity, I will now ask myself, what is the value of the equity? The value of the equity must be higher than the value of the debt. That answers Biola's comments. Now, back to Irabo's comments. That we said lenders might insist on minimum liquidity ratio. And he now said liquidity ratio will bring the business down. That won't that bring the business down? Now, what is liquidity ratio? That you must maintain some level of liquidity to meet your immediate as your long-term obligation. Why is lender interested in liquidity ratio? So that you can pay the interest annually. Payment of interest is financed by cash. If the company is not liquid, to prevent a company from liquidation, let me take that again. The network is breaking. For you to maintain solvency as a company, you must maintain some level of liquidity. You must be able to meet your short-term financial obligations, which include payment of interest to the lenders. Also, you must also be able to meet your long-term financial obligations. So, Erabo, maintaining minimum liquidity, minimum cash. It didn't say excess cash. Look at that one. It didn't say maintain highest liquidity. Maintaining minimum cash to be able to meet your financial obligation as they become due. Without asking you, a company must maintain some level of liquidity. So, what are we trying to say here? I don't know how liquidity ratio will translate to companies going down. So if you can explain how companies maintaining liquidity will bring the business down. If you can explain it.
Okay, sir. Oh, maybe I'm not structuring my question well, or I'm the one not getting the explanation. So what I was saying is, if the lenders are insisting that a company maintain a minimum liquidity ratio, I want to believe minimum simply means that is a lower liquidity ratio.
Yeah.
Okay, so my question now is, if the company is now maintaining a minimum liquidity ratio, meaning, does that not mean that the company will be struggling or will struggle to meet its liabilities? That is short-term and liabilities and the rest, payables and all those things.
Okay, let's look at this now. It's now left for the company to see what is my minimum liquidity ratio. What are those liabilities I must meet in the short term? Do you understand this?
Yes, sir.
What this is saying is that try to invest as much as possible. Maintain minimum liquidity. Don't go. It doesn't even make sense to keep cash in your company. Does it make sense to you?
No, it doesn't.
It makes sense to anybody to keep cash in your accounts. Businessmen, they hardly keep cash in their accounts. Putting cash in your accounts does not give you any money. That cash must be put to work, investment. But the minimum liquidity ratio is to enable you to meet your minimum financial obligation. So what we are saying is invest all your money as much as possible. It doesn't call for too much.
Well, I think I get it now. I get it now. Thank you, sir.
It doesn't cover too much. Even as a business person, it's only if you don't have good business idea that you put cash in your accounts. Say, let me go and keep 10 million in my accounts. Or let me keep 20 million in my accounts. Real businessman will not do that. Immediately they will just invest the money. They will take the risk because putting the money in the banks, they will pay you any interest. Bank is just using your money to do business. All right. We have taken one question. Now let's look at last diet question. Please check the group chat. We share the last diet question with the group chat. I'm going to pick the question now and share my download. I should even have it here. So you can look at your group chat. Last diet question number 5. I'm going to share it now. So we all look at it together. Please confirm you can see my screen.
Yes, sir.
All right, thank you. This question was texted last diet, May diet. Question number 5. Let's look at it together. Omega Industries Limited. Omega Industries Limited is a large Nigerian manufacturing company that has been privately owned for over 15 years. The company has achieved strong profitability and has expanded into neighboring West African countries. Recently, the board of directors has been debating whether to seek a full listing on the Nigerian Exchange Group. The managing director believes that listing will help the company to raise funds for expansion into the renewable energy market, while some existing shareholders are concerned about losing control and facing excessive compliance costs. Look at it. A private company is to be converted to public company. The managing director believes that by listing the company at the stock market, they can raise funds for expansion. Some existing shareholders are concerned about losing control, ownership and control. Once the company becomes publicly quoted, that can affect ownership structure and facing excessive compliance costs. The finance director has asked you as a financial consultant to advise the board likely advantages, the likely advantages and disadvantages to Omega Industry and its shareholders of obtaining a full stock exchange listing. Number two, the factors that should be taken into account when the price of new shares, new equity shares, if the company proceeds with the listing. Requirements A and B. Discuss the potential advantages obtaining a full stock exchange listing. What are the advantages? If you convert a private company to a public company. B, analyze the key factors that should be considered when setting an issue price for new equity shares in a flotation. If you look at this question indirectly is coming from finance success. What are the advantages of going to the stock market? What are the disadvantages? Let's look at it here. The expected solution. So please, your exam is a combination of theories and calculation. So if we discuss theory, please read it. Advantages and disadvantages of obtaining a full stock exchange listing. A full listing means the company shares are admitted to the main market of a stock exchange, subject to the highest and disclosure standard. If you say you want to be admitted, you want your company shares to be admitted to the main market of the stock market. At this market is highly regulated with highest disclosure, nothing secret again. Once your company is listed, everything about the affair of the company will be discussed in the public. What are the advantages? 1, access to large capital. Listing, open access to a wider pool of institutional and retail investors. If your company is listed, you have access to a wide pool of funds. You can raise money easily. It is easier to raise sufficient equity for expansion. That's number one benefit. Number two, enhanced liquidity for shareholders. Examiner says advantages to the company and to the shareholders. For company can easily raise funds. You can raise huge amount of money for the public. To the shareholders, full listing, enhanced liquidity for shareholders. Shares can be traded freely on the exchange market. The funders, employees can decide to sell their shares and realize value. If a company is listed, at any point in time, I can sell my shares and collect cash, making the company more attractive to talent and investors. Number three advantage, improved corporate profile and credibility. Meeting listing requirements signals transparency and good governance. Let me give you this gist. Some companies will not relate with your company if your company is not publicly listed. Let me repeat that point. There are some companies, they will not do business with you except your company is publicly quoted. I know of a case, Shell Petroleum. Shell Petroleum refused to open account with Zenith because Zenith Bank was a private bank then. No, that their company policy, we only open accounts with publicly quoted banks. Because once your company, there's transparency and good governance. This improves reputation with customers, suppliers, lenders, and regulators. Number four advantage, market valuation and benchmarking. The share price, because your company is listed, there's going to be a share price at the stock market. That share price provides an objective continuous valuation. It provides a value for your company. And number five, cheaper future fundraising. A listed company can use right issue or placing or convertible more easily. Look at it. If this company is listed, the company can use right issue to raise additional funds. The company can do placing to raise, can do convertible, a mixture at a lower cost than private pay. What are the disadvantages? One, high cost. Direct costs include underwriting fee, legal, accounting, and listing fee. For you to get your company listed, you are going to incur costs. You are going to engage lawyers, accountants, stockbrokers. After that, ongoing costs, annual listing fee, audit fee. All this will increase the company's cost. Number 2 disadvantage, loss of privacy and increased disclosure. Listed firms must publish detailed financials, directors' dealings, and material events. Competitors gain access to sensitive information about your company. Number 3, short-term market pressure. Once your company is listed, management faces pressure to meet quarterly earnings expectations. It makes you to focus on profit. Because the company is now publicly quoted, they will say 3-month financial report or 6-month financial report. Investors want to see the profit you have achieved within 6 months. There's pressure on the management, no, about profits. Because we are going to file 6 months performance. Our investors, both existing investors and prospective investors, they want to see your earnings. That makes the company to focus on short, which may be at the expense of long-term value creation. Number 4, loss of control. We all know this. Once a company is listed, like this particular case now, a private company, you want to issue shares to the public. Founders' ownership is diluted. So new shareholders will come on board. The board becomes accountable to disperse shareholders, different shareholders. That may lead to what we call hostile takeover. Some people may plan to take over your company. Administrative body, compliance with, so many rules to comply with. Compliance with listing rules, corporate governance code, and reporting requirements increase management times and complexity. Right. That's for 10 marks. Requirement B says What are the factors that determine issue price for new shares? If you say the price is 10 naira or 20 naira or 30 naira, what are the factors that determine an issue price for new shares? In a flotation means that the company is a private company, is floating shares to the public. This private company, we must give the share a price. Like the case of Zenith in 2004 and GT Bank in 2004. Both banks converted to public company in 2004. March 31st, Zenith. April 1st, GT Bank. And we must determine the share price. Or the issue price determines how much capital is raised and how much ownership founders retain. It must balance attracting investor with not undervaluing the firm. Let me explain that. That issue price is very sensitive, just like the price of a product. Similar to price of a product, the issue price for new shares is very sensitive. That price will determine the capital we are going to raise and how much owner founders will retain. We are trying to solve finance. We now want to issue new shares. We must determine the price of the new shares. That price must be balanced between attracting investors. It must not be too high so as to get investors to buy. Again, it must not be too low so as not to undervalue your firm. If the price is too low, that means you are undervaluing your business. What are these factors we are going to consider? 1, company's fundamentals. Company's fundamentals. What are these fundamentals? Earnings. Company's earnings. Cash flow. Growth prospects. If the earnings is very high, your growth prospect is high, investor will pay more. You can afford to quote higher issue price. If the earnings is sustainable, we are going to look at it. What are company's fundamentals? Your financial reports, your earnings, your cash flows, your growth prospects, sustainable earnings and growth, your asset base. Normally I use Zenith Bank When Zenith Bank floated shares for the first time on 31st March 2004, the price quoted was high as 7 naira per share. Yet people were invested. The shares was oversubscribed. Why? Because before then, Zenith earnings was very high. As a private bank, the company's growth prospect potential is very high. The asset backing was high. All these factors will affect issue price. Your expected dividend policy. A consistent dividend policy can influence share price, can influence issue price. Number 2, market conditions. Stock market sentiment. There's what we call bull and bear. In a bull market, higher multiples are acceptable. When we say bull, the market is experiencing boom. Stock market sentiment will affect issue price. If that stock market is experiencing bull, the issue price will go up. In a bear market, you can afford to charge higher issue price. Discounts are needed to ensure take-up. So market conditions will affect issue price. Stock market sentiment. Sector valuation. Comparable companies' price earning ratio. The comparable company price earning ratio we have impacts. Meaning that this company, Omega Industry, we now go and look at it. What is set the industry average? Which company can we compare this Omega to? If you take banks now, we have banks of equal like peers. If you are benchmarking banks now, you are going to take Zenith, GT, First Bank, Access Bank. They fall in the same category. It will be a misnomer to try to compare GT with Unity Bank. That will be a misnomer. The asset base is far apart. Their earnings is far apart. We are not trying to bring down any business. It's a fact that is available. Number 3, risk profile. Higher business and financial risk requires a discount to compensate investors. A startup in a volatile sector will price lower. What we are saying is, if that company risk is high, if the company shares have higher risk, if I'm going to buy the company shares and this company shares or the company is highly risky, then the share price should be low. The issue price should be low. If that company's earnings is highly volatile, number 4, size and liquidity of the issue. Large issues requires a discount to clear the market. If you are issuing large shares, you might need to be at a discounted price to get this, to make people to buy. Investor demand and book building feedback. What does this mean? Investor may tell you this is the price you want to pay. The demand will have impact on the price. In book building, institutional investor dictate price. And when they want to buy, now look, you are issuing your shares for the first time. We are going to buy at this price and this quantity. We call them institutional investors. These are corporate bodies that buy shares and keep. Mostly insurance companies, mutual fund. The final price sets where demand meets supply. The force of demand and supply now, where the demand for the shares is high, where people are eager to buy your shares, you can quote high price. Issue price. You can also use valuation method. Comparable company analysis method. discounted cash flow method, precedent transaction method. Mr. John will teach you some of these things. When you get to valuation of company, equity valuation, and you can have underwriter advice. The underwriters can give you advice. Underwriters aim to avoid a fake IPO. What is IPO? Initial public offer. The first time a company is issuing new shares to the public. The underwriter will advise you so that your initial offer will not fail. They often recommend a modest discount to ensure the share trade up. Right? After the class, you are going to have this shared. So please, you can keep that question in view. If the need arises, we go to that question again and pick. Yeah, Rabo.
So, for the disadvantage for that number, for the A part of the question, can we say, or maybe it falls under the last point you made though, can we say the company will now be open to more strict and regulatory scrutiny? Is it part of this administrative body?
Yes, please. Very correct.
Okay.
That put administrative burden on you. There's a lot of control, external control, compliance. Very correct.
Okay, sir. Thank you.
Hello, sir. Hello, sir. Hello, sir.
Yes,
Can I also add this that loss of some key personnel because they will be highly regulated. For example, like GTB now or Zenith, some of the executive will want to be there forever, but because of the regulatory bodies, so they have to spend certain number of years and yes, sir.
Yeah, you are not right that once the company is publicly quoted, then directors will have limited years to spend. So the maximum, according to the corporate governance, maximum is 10 years. The maximum you can serve is 10 years. So it's also correct. So even though it's the business, you are the owner of the business. Like Jim has left Zenith as chairman. Same applies to Tony Elumelu has left UB as chairman. Because the company is now publicly quoted, so the regulation will apply. After the stipulated years, you have to excuse the system. So it's not, you are not wrong, man.
Thank you, sir.
Right. We still have 30 minutes. Tired. Let's look at a question that will only take 30 minutes. I think there's a question there. If I still have it under your material. Who is chatting with me now? If I still have it, so I think I should have it. I'm looking at your study pack here, sir. Bandage. There's one question I saw here. This one be longer. Ah. Network is very plenty here, sir. All right, let me see the comments here. It's 30 minutes now. It's not 11 o'clock we finish the class. It's 11 o'clock we are going to finish the class now. All right, let's do something. Let's round up the class with Islamic finance so that we don't solve any question again today. Okay, let's just do like 15 minutes. Let's summarize. Let us summarize Islamic financing. Let's summarize Islamic financing. So we take like 15 minutes. Let's summarize Islamic finance. I think for most of us, regardless of our religion self, most of us, we are used to Islamic financing. We have Jais Bank. We have Lotus Bank. We have Summit Finance. In Nigerian business environment now, Islamic financing is growing, and it has nothing to do with a religion. It's just that some of us we instead of reading, we listen to what people say. If you are privileged to go to Europe, UK, Islamic finance is very pronounced. So what is Islamic finance? How is it different from conventional financing? Now, if you say Islamic finance, a finance that is based on the principle of Islamic law, lending and borrowing to finance your business based on Islamic perspective. Under the Islamic law, interest is prohibited. So when you say Islamic finance, it's a finance that we call non-interest financing. Under the Islamic principle, interest is prohibited. You cannot accept interest. You cannot pay interest. That is a major difference between conventional financing. That you approach an Islamic bank to obtain loan, and the bank is not expected to charge you interest. The question will now be, how do this Islamic finance bank make profit? If they can give loan, or they can provide finance based on the principle of Islamic law, where interest is completely prohibited. It is believed that the issue of interest is an unjust process. You are giving loan, you are charging interest. That's an unjust. Money is not an asset that can be traded. Rather, money is a medium of exchange. You cannot sell money and buy money. You can only use money to facilitate transactions. So the question again is, how do Islamic finance companies generate returns? We have different products. We have different products used by Islamic finance business, finance company to generate income. One of them is Musharaka. Musharaka Islamic finance. This finance, Musharaka finance, is a profit and loss sharing partnership. Musharaka finance is a profit and loss sharing partnership and the most authentic form of Islamic finance. It's a contract of joint partnership where two or more partners provide capital to finance a project or a business or estate, either on a permanent basis or diminishing basis. Two partners that make a bank, two partners comes together to provide finance to fund a business. The partners in Musharaka has a right to take part in management. For this mode of financing, both partners will share the profits. If a profit is generated on the business, both the bank and the customer that form partners will share the profits according to pre-agreed ratio. Also, when losses are incurred, both the partners, that is the bank and the company, will share the loss. Look at it. So for Islamic finance, they can do musharaka. Islamic bank and the customer will go into partnership to finance a business. When the business generates profits, both the bank and the customer will share the profit. Where the business incurred losses, both the bank and the customer will share the loss. In this case, no interest. That is one. So to generate returns, Islamic bank can go into musharaka financing. Number two, mudaraba finance. It's a profit sharing and loss bearing contract. A profit sharing and loss bearing contract where one party supplies all the finance needed. One party supplies all the finance needed. The other party provides efforts and management expertise. With a view to generating a profit. Look at it. Mudaraba. The bank and the customer go into mudaraba contract. The bank provides all the finance for the project. The customer manages the project with a view to generating a profit. If profit is generated, this will be shared between the capital owner and the manager of the enterprises. The profit will be shared between the owner of the capital and the manager, that is the company. But in the event of loss, the capital owner will bear all the loss. In the event of loss, the capital provider will bear all the loss. The customer will not bear any loss. The customer that manages the business will not bear any loss. Will not bear any financial loss because he has lost his time, his energy, invested in running the business. That's the principle of mudaraba. Don't forget, the bottom line is that interest is not allowable under Islamic finance. Also, Islamic finance, you cannot use it for unethical business. Business or businesses that are injurious to public health, like alcohol. You cannot fund alcohol business with Islamic finance. That business is injurious to public health. All right, let's round up. Muraba, Islamic finance. is a popular Sharia compliant sales transaction, mostly used in trade and asset financing. Muraba is a popular Sharia compliant sales transaction, mostly used in trade and asset financing. How does this work? The bank purchases the goods and delivers to the customer, deferring payment to a date agreed by the parties. The expected return on Muraba is usually aligned with interest payments on conventional loans, creating a similarity between Muraba sales and asset-backed loan. Let me explain that. Assuming you understand, you have gotten baking knowledge. You can bake bread, you can bake cake, you can bake snacks, and you require an equipment for this purpose. You don't have the money to buy the equipment yourself. You can approach Islamic Bank to enter into Muraba contracts. The bank will purchase that equipment on your behalf and deliver the equipment to you. You are the baker now. You are the bank customers now. Bank buys goods and deliver to the customer, deferring payment to a date agreed. So you now be paying the bank at a later date with expected return. That expected return is usually aligned with interest payments on conventional loan, because the bank has taken that risk for you. They will be compensated for that risk. Ijaro. Ijaro is simply leasing. Lease. For conventional finance, we say operating lease. For Islamic finance, it's called Ijaro contract. A contract of sale of the rights to use an asset for a period of time. This is essentially a lease contract whereby the lessor must own the lease asset for the entire lease period. Under Ijaro, company obtain use of non-current assets through leasing. You are going to be paying leasing rents to the owner. The lessee pays rents to the lessor so as to use the asset of the lessor. But please note, ownership is not transferred. Ownership remains with the lessor. Finally, Sukuk. Sukuk bond. Sukuk is the Islamic equivalent of bond. They are similar to asset-backed securities. When you issue bond, when you issue Sukuk, you are trying to raise funds for a specific asset. Assuming you are asked, what's the difference between Sukuk, Islamic bond, and conventional bond? Assuming you are asking your exam, differentiate between Sukuk bond, that is Islamic bond, and conventional bond. Conventional bond is a promise to repay a loan at maturity. Conventional bond is a promise to repay a loan at maturity. Why Sukuk bond? Sukuk constitute partial ownership in receivables. Let me explain that. For Islamic bond, the loan is not repaid. That bond is used to construct an asset. That bond is used to construct an asset. The investor in Sukuk becomes owners of the asset. And they will continue to get return on the assets. Inasmuch as the asset is still in existence, they will get expected return. But the bond will not be redeemed. Let me illustrate this briefly. Government can issue Sukuk bond to construct hostel. University of Lagos, Lagos State University. Government want to construct hostel. Government now issues Sukuk bond to the public. The public, investors now subscribe. When the money is generated and used to construct the hostel, that hostel is the asset now. The investors in that bond become the owners of that hostel. Partial ownership in receivables. That hostel will generate money annually. When money is generated, certain percentage will be distributed to the investors in Sukuk. Certain percentage will be maintained, will be kept to maintain the facility. Returns will be paid to the investor, but the principal amount will not be repaid. That is the main difference between Islamic bond, Sukuk bond, and conventional bond. Conventional bond, the principal amount is repaid. All right. It's a good way to round up that class. Any question? All right. Just as you are tired, I'm equally tired. But we have to just manage it. Let's have a blessed evening. Good night.
Thank you very much, sir. Good night,
May
sir.
God give us a better understanding.
Thank you,
Amen.
sir. Amen.